Back to you.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the brand new year of The Real Investment Show. We're glad to be back after taking a break for the end of the year. So happy to be back with you today. Monday, January the 6th, but of course this is also a holiday shortened week. We have another holiday coming up on Thursday, January the 9th. Brent's looking all confused this morning. You don't know that Thursday is a holiday. It is to commemorate the passing of Jimmy Carter. So the markets will be closed on Thursday. We'll still be here. We'll do a live show on Thursday because we've already been off for like 6 years. So we'll be here on Thursday to talk about something. Michael Leibowitz will join me on Thursday. We'll catch you up on bonds and interest rates, Fed, all that stuff on Thursday. But the markets will be closed on Thursday. And then, of course, we'll get back into kind of the regular flow of things after that. So, again, this is kind of the official kickoff to the new year. Santa Claus did not come this year to Broad and Wall. And the old saying is, if Santa Claus fails to visit Broad and Wall, well, what does that mean for the new year? Typically, that means lower returns, which is interesting because right now, every single analyst is bullish for next year. In fact, the median estimate right now for next year is for the market to get to about 6650 on the index. So it's quite a bullish outlook across the board. But again, we just had this poor performance. And again, as we can, kind of saw now, Friday we had a decent rally. And we'll get into this a little bit more when we talk about, the segment on Before the Bell. But again, that's kind of the kickoff for the new year was that second trading day of the year. That's the end of the Santa Claus rally. That didn't occur. But all is not lost. The January barometer is, of course, also very important here, and we'll get into those details here in just a second. But outside of that, economic data continues to be, kind of mixed. In fact, over the holidays, we kind of saw some of the economic data coming in. Some of it did show some signs of improvement, but underperformed expectations. In other words, it didn't beat estimates, but we did see some improvement in ISM manufacturing. But one of the issues with a lot of this economic data is it's sentiment driven. And right now there's a lot of optimism about the economy because of the election and what Trump's going to do, et cetera, some of the policies, deregulation, lower taxes. So again, manufacturers are optimistic that things will improve in 2025 as we kind of get into the midst of some of these policies. But again, one of the problems with surveys is they are sentiment driven. So if things don't come to fruition pretty quickly, in other words, if we don't start to see actual sales and revenue pick up, and we don't actually see people going out and shopping to a greater extent, and again, we're about to start getting all of the retail sales reports for December. We'll get a look at just how strong the Christmas shopping season was. If we don't start seeing improvement, these sentiment surveys will start to turn back down again. We saw an improvement in leading economic indicators, finally pulled back into positive territory after being negative for one of the longest stretches in history. We did see leading economic indicators turn positive. That suggests the economy is going to improve. We'll see. But again, an improving economy and a strong economy can be very different things. And one of the issues that the market faces this year in particular is the fact that you're going to need to sustain pretty strong economic growth to meet the estimates that analysts currently have. Now, right now, analysts are expecting earnings to grow to about $249 a share. Now, this is according to S&P right towards the end of last year. They're expecting 249. Estimates for the fourth quarter are at 208. So you're talking about a $40 increase in earnings in 2025. That's a pretty big jump, right? And so you're going to need pretty strong economic growth to support that. We'll see if that can occur. But again, I think that's one of the bigger risks we'll be talking about a lot this year is just how strong those earnings actually turn out to be. Just as a good example, 2024, analysts expected a 14% growth rate in earnings, turned out to be 9%. So again, we'll see, and this is why valuations are rising, obviously, because investors are still bidding up stock prices, but earnings aren't growing as fast as expectations were, and this is why we're seeing valuations increase. But here's what you need to know before the bell this morning. As I said, Santa did not visit Broad and Wall over the holidays, and again, a little bit disappointing, but we did have a nice rally on Friday. They got us right back to the 50-day moving average, but that was below where we actually started the 7-day period. So we came up about 0.5% short on the Santa rally. So Santa rally failed. Now, what does that mean for the year? Well, typically when there's kind of a three-phase, kind of indicator cycle of this. So you have the Santa Claus rally, the first 5 days of January, and then the full month of January. And that's typically your predictor for the year. Now, when just looking at the Santa Claus rally in years where you've had no Santa Claus rally, market returns tend to be lower a large percentage of the time. Now, not always. Again, we didn't have a Santa Claus rally in 2023, and we had a boomer 20% plus year last year in the market. So these indicators aren't always correct. So always, take these with a grain of salt. But again, this is kind of, the expectation for this year-end rally just did not materialize. So a bit of a disappointing performance. We saw the market kind of peak mid-December and has really just kind of been rolling over ever since. And so we haven't really seen that pick up. Now this morning, futures are pointing higher. Dow's up about 137. S&P's up about 30 points this morning. So we'll hopefully get back above this 50-day moving average and start moving back towards that 6,000 level on the S&P. Now, if the markets can get above that, break above the above 6,000 here, then of course we'll try to retest these December highs, and that's going to be kind of the look for the month of January. So, if we get the first 5 days of January to be positive, and that would also typically predict a full month to be positive, that typically leads to a fairly strong year. In terms of the markets, about 10 to 12%. So again, if we're going to start getting some kind of bullish bias to the markets, it needs to kind of start here soon. Markets are oversold here. We're still on a momentum sell signal. Relative strength is decently oversold. So we're in a good setup here for a bit of a rally towards the January 20th inauguration. So the inauguration is on the 20th. That's when President Trump will take the oath of office. Markets tend, in presidential election years, markets tend to rally into that inauguration. So with markets oversold, we've got a good setup now for the markets to make this rally over the course of the next couple of weeks. Post-inaugurations, historically, markets tend to be weaker because, again, this is the first 100 days of office. We're going to immediately start seeing executive actions and these type of things. And so there's going to be some stuff that's going to potentially weigh on the market. So the market tends to be weaker in February and March. So again, a bit of a rally in the inauguration, maybe sell into that, rebalance portfolios, kind of position yourself for the new year. In particular because, again, expectations for this year are extremely elevated. Everybody's very, very bullish. And as Bob Farrell once said, when all experts agree, and they all agree right now, something else tends to happen. So use this rally here, kind of look at your portfolio, how much risk you're taking. Again, remember, we've had 2 very, very good years in the market. Don't keep taking excess risk, expecting years like the last 2 years to continue to repeat themselves. They don't historically, and you're typically kind of setting yourself up for some risk. So, I've got an article coming out tomorrow talking about Larry David and curb your expectations. Curb your expectations for this year. I think you'll be better off. That's what you need to know before the bell this morning. We'll come back, talk about markets, your money, more right here on The Real Investment Show.
daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
Will you be turning 65 in 2025? Happy birthday! But there's a Medicare special enrollment period in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors, online resources, and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid those gaps in coverage. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So good morning. Welcome back to the Real Investment Show. I just checked the website, realinvestmentadvice.com, and January 18th, right? Not this Saturday, but next Saturday is our live investment summit. Myself, Michael Leibowitz, we're going to be going through everything. Stocks, markets, bonds, interest rates, economy, whole nine yards. Adam Taggart will be there. We'll have a kind of a live Q&A talking about everything. Richard Russo, Danny Ratliff, the entire RA team will be there. That graphic that Brent put up is wrong because it has not been updated on our site yet. It is still $99 right now for general admission. It is going to go up today when somebody wakes up and actually changes the graphic on the website. But if you register right now, it's still $99. So go save yourself $50 and register right now on the website because you get somebody's laziness to your advantage because they didn't swap out the graphic yet. Yeah. So, but I just checked the website. It's still $99. So if you want to come, it's next Saturday, January the 18th. Love to have you. We're going to have lots of time for just face-to-face, kind of talking in between breaks and answering all of your questions. It'll be a lot of fun. We did this last year. It was a very nice event, but seating's pretty limited. We've rented one room. I think there's about 120, 130 seats altogether, and most of those, we've probably sold more than half the tickets already. So again, I would definitely take advantage of this kind of mess up on our side and go get your tickets for $99 right now. I don't know when that's going to change. It's going to change this morning, pretty soon. So, but I just checked the website; it's still $99. So I would do it now. So, welcome back, Brent. Thank you. Nice to have you back.
Thank you very much. Good to be here.
Did you have a nice holiday?
We stayed home.
So did we.
Yeah.
So did we. And actually, I'm kind of glad to be back today. After about 4 or 5 days of being at home, I was like, yeah, I'm ready to go back to the office for a bit.
I was a nurse.
Oh, yeah, that's right.
The whole period.
That's correct. How's your wife doing?
She's doing much better, but major surgery, long recovery.
Right. And she's a terrible patient.
She is.
Yeah.
And she's not listening this morning.
Yeah. I'm married to one of those too.
Big red letter day today.
Yes.
My first day with coffee in 2 weeks.
Really?
I did not have coffee the entire holiday because I didn't need it.
I thought you were just self-inflicting pain.
I wanted the first cup today to really have a good effect.
So and it did.
Yeah.
So perfect.
So.
Okay. So I was wondering why you're all excited over here today. Anyway, welcome back. And welcome back to everybody in the chat. We appreciate you being here. So I hope you all had a very happy and kind of happy holiday. Merry Christmas. Happy New Year. It's January we're into January of 2025. Hard to believe. I should be dead soon. As fast as years are going by. But there's a lot of things to be kind of looking at as we go this year. And part of what I wrote in this past weekend's newsletter is kind of going through 2024. And I've been getting a lot of questions as of late from readers and subscribers, watchers, etc. And I appreciate all the emails y'all send me, and I've tried to answer every single one of them. But I'm getting a lot of questions here recently just about, oh my gosh, we've had 2 years, 20% plus returns. That's got to mean something. And it does, right, historically. But it's important to understand that momentum begets momentum. And when you're in a market driven by a lot of exuberance and excitement, people are willing to take on just increasing levels of risk. And you really kind of push the limits, right? Because we get used to things, right? As humans, we get used to things. Daniel Kahneman was a psychologist, and he did a bunch of studies on human psychology and just really how we deal with information and how do we process information and the habits that we do things in. And he was looking at it more from just kind of how humans operate, right? How we experience pain, how we deal with pain, and how fast, as a good example, kind of how fast we forget pain, as a good example, right? Because if you think about cavemen back in the day, when I was first kind of born, according to my kids, right? So stone tablets and hunting for animals. But if you went out and you went out with your buddy and your buddy gets eaten by a dinosaur, right? Your kind of initial behavior is, well, I'm not leaving the cave ever again, right? but you have to leave the cave to go eat. And this is how we process information. This is why people remember having gone through the 2008 financial crisis, and they remember bad stuff happens, but they don't really remember the effect of the pain they felt at the time. And so we typically start to invest as if that was a one-off event. It's never going to happen again. And we start taking on excess levels of risk. Another thing that we do is we try to have, we do remember that event. And so another behavioral aspect that we pick up is called loss aversion. It's like, I'm just never going to do that again. And so I'll never be in that position. So we do things like we don't ever invest again. And so we just go do other stuff. So all these behaviors impact our investment outcomes. There's herd bias and we've talked about confirmation bias, all of these things. These are all the biases that we have psychologically that impact our investing. And it's very hard if you don't recognize these biases. And the reason we spend so much time talking about them on the show is that if you don't recognize the bias, then you fall into the trap without really even knowing you're in the trap. Right. And then it affects your outcomes. And this is why we talk about all these things all the time and try not to get trapped into being bullish or bearish. Just, look at the data for what it is, because that helps you avoid getting trapped in some of these psychological biases. So it's not surprising after 2 years of 20% returns, people are like, well, if you've had that, you're definitely going to crash. Right. I mean, the crash is right around the corner. Not necessarily. Here's a chart of returns. This is annual returns. And now this chart only runs through 2023. I don't have the 2024 number yet, but it just took another year on the far right side. But returns greater than 20% in a year occur 38% of the time. So it's not an anomaly that you have a 20% return year. Having consecutive 20% return years is also not an anomaly. If you look at the data, you'll see several years that are kind of clustered together. 1927, 1928, And of course, immediately everybody goes, well, yeah, remember what happened in 1929? Yes, we'll get there in a second. But there's plenty of consecutive years where the market rallied and had 20% returns. Markets return 10 to 20% a year, 21% time. So if you look at just the data alone, just look at annual returns, 59% of the time, you're going to have a return of greater than 10%. So, we talk about long-term average returns of 6 or 7 or 8%, right? Average returns aren't really very normal. But those are the risk, right? Because you do have down years, but down years of greater than 20% only occur 6% of the time. Now, those are more devastating, right? So we can't ignore them, and we shouldn't ignore down years, right? Because they have a big impact on the compounding of capital returns as well as eating up our time. Because the one thing we can't replace in the markets, we can always replace capital. We can't replace time. So I'm not dismissing that down years are very important, because they are. We have to try to avoid those. But if we spend all of our time trying to avoid a drawdown that occurs 6% of the time, it puts us way behind the curve. So now let's address some of the questions. If we take a look at, this chart is the annual returns of the markets going back to 1928. Now, this data is from the Yale School. It's just annual returns. But if you take a look back, 1927, 1928, we had back-to-back 20% return years. And, of course, you had 1929, 30, 31, 32, but really bad years, right? There's one thing that should jump out of this. And, if you're concerned about markets being overly exuberant, there's a reason to be concerned. Because when you have back-to-back 20% return years in a row, typically, not always, but typically you tend to have lower returns in the future. Sometimes they're corrections. Sometimes they are bear markets. Sometimes they're just lower returns. You have just, a 5 or 6% return year after that. But you can have very long stretches where you have a couple of 20% return years, maybe a little bit lower return, than another, 10% year, 15% year, and then you have a downturn in the markets. The markets will have a downturn at some point. No doubt about it, because that's just what history tells us will happen. The timing of that event is always the hard part. So as we start looking into 2025 and thinking about, okay, where are we now? What's the risk? Of course, we've got, valuation issues, certainly a big concern. We've got issues about, economic growth. Is it sustainable? Issues about higher interest rates, higher inflation, the impact on consumer spending from that. There's certainly reasons to be concerned about 2025, but there's a lot of bullish momentum right now in the markets that we need to be conscious of. And again, the bias of the market currently is to the upside. Technicals support that in the short term. The fundamentals become more challenging as we move further out into 2025 and into 2026. We'll talk some more about this when we come back from the break. Stick around, more of the Real Investment Show coming up. And hey, don't forget, get by the website, get your tickets for the Economic and Investment Summit before the price changes today. It's on the website now, realinvestmentadvice.com.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. 2019. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today. Register today.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I think you're really right on that, Lance, and I don't say that often, but
you better be glad we're still broadcasting on radio. When we come to YouTube, I'm going to tell you what I really think about your comments.
The Real Investment Show podcast.
I know I've got this little safety net right now.
Same show, your schedule.
Can't cuss me out.
Exactly. If we ever go to straight YouTube, man, it's going to be bad.
At realinvestmentadvice.com.
This is going to be an R-rated episode of the Real Investment Show.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So just talking a little bit about, kind of wrapping up 2024 and these kind of back-to-back 20% return years. And there's a lot of optimism for this year. And I'm a little bit more sanguine on my outlook for 2025. Still in that I want to say 2024, right? Can't quite get there. Yeah, I'm a little bit more sanguine on my outlook for 2025 for a variety of reasons. And in the chat, there was some conversation about tariffs. And, the tariffs issue with Trump is, again, you go back and look at the data, 2016 well, really, you can't say 2016. The election was in 2016. So 2017 through, his term. We had tariffs. It's a lot of stick and carrot. As an example, and it's like, I'm going to hit you with 100% tariff, then you negotiate something, right? And so the tariffs were not that big of a deal. They didn't really impact markets much. Markets actually did pretty well. In fact, in 2018, we had a correction in the last half of the year as the Fed was hiking rates, and we're nowhere near the neutral rate yet. And then, of course, by the end of December, all that policy had reversed, and we went into kind of a market melt up into 2019 and really all the way into early 2020. In fact, we were writing some articles in early 2020 talking about this market melt up we're having. And so, the market was doing great even though you had tariffs. So there's a lot of misinformation about tariffs. And again, just if you go back through history, and we've done this before, if you go back, to the early 1900s, and 1915 through really kind of 1950, a big chunk of the revenue that we generated came from tariffs and excise taxes. We had very, very little personal income tax. Most of it was from tariffs, and the economy, functioned. So, and we didn't have raging inflation, and we didn't have all these other things that, people talk about. So again, just a little bit of historical review kind of takes some of the edge off these tariffs. But again, that's kind of the big focus of markets right now. Oh my gosh, tariffs are going to cause inflation. They actually don't, because people make substitution choices, right? If I can't afford to buy a product from China, I'll buy it from Vietnam, right? Wherever there's not a tariff. So, or they just don't buy the product, whatever it is. So consumer choice makes a big difference in an economy that's 70% driven by consumption. And so this is something to be aware of. But as we do go further into 2025, I certainly have some concerns. One of those concerns is just the massive amount of speculation that we have going on in the markets. We talked about this, recently. But what's been quite shocking was the amount of money flowing into the markets in 2024. So we didn't have stimulus checks and debt moratoriums and all this type of thing that gave people excess cash to invest. But yet we had very, very strong inflows. There's a chart of U.S. ETFs as a good example. We had more than $1 trillion by the end of the year. This was in November, this chart came out. But by the end of last year, we basically hit $1 trillion flowing into ETFs. In a year where the only other time we got close to that record kind of jump, right, was that big push in 2021 where people had a bunch of stimulus checks. And so they were speculating in the markets, and which is fine. There's nothing wrong with that. But that's why markets did so well this year in particular, or in 2024. You just had so much money again, and we've talked about the passive impact of ETFs, right? So every dollar that goes into an ETF, basically 40 cents of that flows into the Magnificent Seven, and that's why those stocks performed so well again last year. But importantly, it's not just the ETFs; it's where investors are piling this money into, and they're piling that into leveraged ETFs. Right, so they're wanting to take $1 and they're wanting to turn it into $2 as a function, and so using these 2x leveraged ETFs, 3x leveraged ETFs, we've seen just a massive surge. Now, the last time we saw such a big run up, again, 2020, 2021, then you got into 2022, and since October of 2022, everybody's like, "Hey, that worked really well before. Let's do that again." And they're piling right back into the same set of these types of leveraged ETFs. And in particular, single stock leveraged ETFs have just gone off to the moon. It's just absolutely amazing. We haven't seen this ever. But again, we've talked about this before, is that Wall Street doesn't issue product for your benefit. Right? They don't issue a product that says this is a good product for the average retail investor. The average retail investor should own this product, right? It's good for them. If they invest in this product, it'll help them over time. No, that's not the way Wall Street works. Wall Street says, NVIDIA is going off to the moon, so let's issue an ETF that just owns NVIDIA or MicroStrategy, and we won't even own the stock, right? We'll just own the options on the stock, and so we can get like 3-4 times leverage. And boy, people can just speculate in this and just make a bunch of money. And so Wall Street is more than happy to meet demand for products. So when there's a big demand for any product, Wall Street's happy to meet that because they're going to make money off of it. You may not make money off of it, but they'll make money off of it. And so we're seeing a big rash of products. Now, the last time that we saw Wall Street meeting demand like they did last year was in 2021. And in 2021, remember, we had SPACs and IPOs and all this other stuff that was coming out because there was a lot of demand. People had money, right? We sent them checks. They wanted to invest it in the markets. And they're like, what do I invest in? Like, here's a new product for you.
And they were happy to meet it. Of course, that didn't work out well. We had a lot of speculation, a lot of hype, had people chasing Bitcoin, all that type of stuff back in 2021. All the meme stocks, right? GameStop, AMC, all those. And it worked out well for about a year. And then, of course, 2022 came along, and a lot of those investments collapsed entirely or lost 80 to 90% of their value. And this is an important point when we're talking about investing. You know, there's a lot of concern. I get a lot of emails like, well, I'm just worried about the market collapsing by 50%. Okay, that could happen. It's rare that it happens. And it doesn't happen overnight. Right? So if you say, well, I think the market's is going to drop by 50%, that's great. It's not going to happen overnight. Financial crisis didn't happen overnight. The market was deteriorating for months before we got into the Lehman shutdown that caused a very sharp drop in the markets over a 5-day period. You'll have plenty of warning sign that something is going wrong and you're going to suffer bigger drawdowns. 2022 is a good example of that. When you look at your portfolio, if your portfolio is comprised of a lot of risk, if you've got a lot of single stock leveraged ETFs and micro strategy stock, whatever else in your portfolio, you're taking a lot of leveraged risk. When the market does correct, you're going to lose dramatically more than the markets. Again, 2022, great example of this. In 2022, the market was only down about 25% at its worst point in October. A lot of retail investors lost 80 to 90% of their portfolio, 70, 60, 50, right? They were down much more than the markets because of the investments they were in. Cathie Wood's, ARK, the ARK fund, right? Down dramatically more than the overall market, right? Stocks like Roku and others down dramatically more than the markets. So it's not the market, right? When people talk about, oh, the market's going to crash and you're going to lose all your money, that's not true. It is true if you own a bunch of crap assets. And if you own a bunch of assets that are leveraged risk, you're going to lose a lot of money. Leverage works on the way up, and it works really great on the way down. But if you have a well-balanced, diversified portfolio where you've got good quality companies that are generating revenue growth, pay a dividend, those type of things, you're going to, even on a buy and hold basis, you're going to weather a downturn much better. So this is one of my big concerns for 2025, and I don't think it matures this year. I think it may be 2026 before it matures. But the level of speculation that we're seeing in the markets right now is really exuberant. People are not concerned about risk. They're not concerned that the market is going to have a sharp decline. That's typically a good setup for a market to have a sharp decline at some point. And again, it doesn't mean, I don't want you to take away from this saying, oh, Lance said the market's going to crash. I'm not saying that at all. Events like we saw in March of 2020 don't happen, right? We shut down the economy. So the market immediately had to adapt for an assumption of an economy that was shut down. Typical bear markets last 18 to 24 months. And they're grinding, brutal events over time. And if you're just going to sit on your hands and do nothing during that environment and just write it down, yeah, it's going to be a terrible experience. But we're going to see that occurring, right? If you're listening to the show, we're going to say, hey, look, we're moving into a different environment here. We need to raise cash. We need to do these type of things. We'll tell you this, right? Because that's what we'll be doing with our portfolios. But people running around going, oh, the market's going to crash tomorrow and you're going to lose 50% of your money. That's not going to happen that way. Unless, right, we shut down the economy overnight without warning. Just tomorrow morning, economy shut down. It's probably not going to happen. But there's other risk out there. And one thing we'll talk about when we come back is earnings, because that's the big thing we've got to be paying attention to. If you're expecting high rates of return in 2025, earnings is the risk to that outlook. And we'll talk about that coming back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
You're listening to The Real Investment Show.
So just before we went to break, I was talking about the one thing we're going to be paying attention to this year is earnings. And analysts are very, very optimistic about earnings. By the way, be sure and hit the like button for us on the channel this morning. We appreciate it. Starting out a new year, so we need to make sure Google likes us. So your participation in liking the channel certainly helps. And if you don't subscribe, be sure and subscribe to the channel as well, so you'll get notified when we put out our daily market updates, those type of things, emergency alerts, all that. That'll be there for you. But earnings are the thing to really kind of watch for this year. Here's a long-term. This is a logarithmic chart of earnings for the S&P going back to 1936. Now, what's important to note is the exponential growth trend. And whenever, which is that orange dash line that is in this chart. So again, if you're just listening on the radio this morning, don't worry. All these charts are in our newsletter from this weekend. So just go to the website, click on the Bull Bear Report, and you can see all these charts that are there. What's important to note, though, is that when earnings get too deviated, and it's a very defined channel from peaks to troughs of earnings over time. When earnings become too deviated from their long-term exponential growth trend, and where does that trend come from, right? It comes from economic growth. If I put a chart of GDP up here, it'll look almost identical. Earnings come from economic activity. Coming out of a recession, you can have very sharp spikes in earnings because things get really locked down during a recession. And then, if I'm, again, it's about numbers in general, kind of the law of numbers. If I'm earning $100 a share, to go to a 10% increase, I've got to go to 110, right, dollars per share. But if my earnings collapse during a recession, and now I'm making $10 in earnings, if my earnings increase by the same $10, I have 100% return or growth in earnings from $10 to $20. right? So coming out of a recession, it's not surprising to see very, very sharp increases in earnings. But what's important to note is that these deviations from the long-term growth trend are not sustainable because economic growth isn't producing the earnings that are needed. Right now, and I mentioned this at kind of the opening this morning, but this is the chart that shows it. Right now, analysts are expecting for 2025 that earnings will grow to $249 a share. The long-term exponential growth trend is 181. So you have a very, very big gap between expectations and the long-term trend. The last time we were here was in 2021. And then we had a downturn in 2022, which brought earnings almost back to the exponential growth trend. And then we kind of took off again from there because we did the Inflation Reduction Act, we did the CHIPS Act, we did all this other stuff. Well, we don't have those fiscal spending bills in place now, or at least not on the horizon. So one of the big questions for 2025 is how are you going to generate above average rates of economic growth to generate above average rates of earnings growth? I think that is the big risk to more exuberant outlooks for the markets this year, where people are expecting, 7,000 on the index or 7,200 on the index. So you're talking about putting 1,000 points on the index. The index closed below 6,000 at the end of last year. So you're talking about adding 1,000 points to the S&P this year. But if I just take the median of Wall Street estimates at 6,600, so you're talking about adding 600 points, on top of the index this year as well, which is doable, right? That's only a 10% return. It's certainly doable. But the risk, again, if I'm going to increase the market by another 10%, but I'm not growing earnings at that rate, my valuations become more of an issue. And at some point, the market is going to start to run out of the ability to rationalize overpaying for valuations. And then that's when you kind of get this correction in the markets to revert prices back to what earnings growth actually is. And so if we get earnings growth closer to, 5 or 6% this year, which is very possible. Of course, this will depend on policy coming out of Washington. Again, whether it's tariffs or whether it's, deportation or, whatever it is, right? The Department of Government Efficiency, slashes government employment. All these things will have an impact on economic growth, which will have an impact on earnings. So I think that's the big risk we've got to pay attention to. But again, when you start talking about and reading about, and people are saying, we're going to have a crash, et cetera, be a little careful with that. That's psychological bias. Again, we're going to have plenty of warning indicators to tell us that there's risk increasing in the markets. And right now, there's no risk. Here's a chart of the Treasury bond to high yield junk bond spread. So this is Treasury bonds to double B rated spreads. So double B bonds are basically the beginning of junk bonds. So double B, single B, triple C, double C, C, right? Down into the Ds. Those are all your junk bonds. Right now, there is no risk in the markets perceived. You've got one of the lowest levels of credit spreads between Treasury bonds and high yield bonds on record. Now, it's worth noting that very low periods of low credit spreads like we're in now typically precede other events and market downturns. But this doesn't mean, there you go, Lance. See, there's your indicator right there. It tells you that we're about to have a crash. Careful with that. The one good thing about credit spreads is that they are a very good leading indicator to market outcomes. Credit spreads turned up in 2007. They were warning that the market was getting in trouble heading into 2008. Credit spreads will give you a decent lead time over market downturns. And this is why we watch them so closely. It's the one indicator that you should pay attention to, is taking a look at credit spreads of various types. Because because again, we've talked about this before, the bond market is total fundamentals, right? It's just simply, I've got a fixed rate of return that I'm dealing with, and that rate of return has to compensate me for opportunity risk, credit risk, default risk, economic risk, all those type of things. I don't get to change it. Once I issue debt at a rate, I'm stuck with that rate. So I can't change it. So I've got to make sure that rate is going to compensate me over the period of that duration of that bond or that loan, that's going to compensate me for all those risks. And that's why when the bond market starts seeing risk really increase in the markets, rising defaults, blah, 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 they're going to start asking for more in terms of yield. And when they start asking for more yield, credit spreads will start to rise. That's your warning sign. Right now, we don't have a warning sign. They haven't turned up. Right now, everything's fine. It's worth paying attention to. And this is why I'm saying one of the risks that, and again, when we come back to all of this, I think the risk for this year and the thing we've got to be paying attention to is an increase in volatility. I do think that at some point this year, we'll have a 10% plus correction at some point this year, just like we did last year. We had 8.5. It's close, right? We had a 10% the year before. So a 10% correction, totally normal in any given year. And I think we could see that again this year. Markets are certainly set up for that, right? Any type of disappointment is going to cause a market correction because of technically we're extended, technically we're very overbought, we're very well deviated from longer term means on a weekly and monthly basis. We've got a very good technical setup for a correction this year. What causes it? Don't know. When it happens, don't know. This is the problem, right? We don't know. We can't time these things. We just need to be aware of them and be paying attention to it. So, watch the risk you're taking in your portfolio. The other risk I think this year is that it's going to be a disappointing year in terms of returns, and I don't mean negative returns. But people are going to be, if you get a 6 to a 10% return this year, people are going to go, man, this year kind of sucked, right? After two 20% years, a 6% year or an 8% year is going to seem pretty dismal, right? It really didn't go anywhere. But that's going to be normal, right? A return to normality in terms of returns may be disappointing. And so you've got this lower rate of return expectation with a higher risk of volatility, which could make this a bit of a challenging year in terms of managing portfolios. And, I don't think that's unreasonable. I think it's something we're going to have to navigate, and we'll certainly do it with you here on the show every day. But I think that's the attitude we've got to have going into this year. Now, if something else matures and things are great and we rip off to another 20% plus return year, it could happen. That's an easy fix, right? We just add exposure at that point. But I think betting on that going into this year, given the backdrop, and again, if you got, and we have a lot of charts and stuff that we went through in terms of markets and returns and what worked, what didn't work last year in the newsletter this past weekend. But I think once you start thinking about the look forward, I think you have to be a little bit more cautious about your outlook this year. But again, we'll navigate it as it comes along. Be sure to go by the website and get our latest newsletter, blog. Our daily market commentary is up this morning already. It's there for you as well. Have a great day, and make sure to get by the website and get signed up for the Economic Summit before the price goes up today. So they haven't changed it yet on the website. So go do it now. Lock in, save yourself $50 this morning, and we'll see you at the summit next Saturday. All right, have a great day. We'll see you tomorrow.